Well, good afternoon, ladies and gentlemen, Honorable Governor, Deputy Governors, and members of the press, as well as people from RBI. It gives me immense honor to introduce my team. I am the governor for my team from CET Bhubaneswar. My name is Arghya, and he is Satya Prakash. He is the Deputy Governor for Monetary Policy, and his counterpart, Debabrata, is the Deputy Governor for Financial Markets. And so, should I start now, like presenting? Thank you very much. So, so this is a critical juncture at which RBI is actually faced with two crises, I should say. So, in that sense, let us first move on to the basic policy recommendations that our team is going to make. So, no surprises over there. There shall be no reduction in key policy rates, and that is what we feel. The policy rate, that is the repo rate, the reverse repo rate, the CRR as well as the SLR, they remain pretty much unchanged at the levels which they are today, notwithstanding the fact that we had a reduction today. Now, moving on to the other recommendations, ladies and gentlemen, as you all might be knowing, we had a sort of a macroeconomic development in which some crisis in the Middle East actually led to an increase in the fuel prices as well as an increase in the interest rates of the Federal Reserve. So the instruments which we use, that normally RBI uses, we have actually tweaked it a bit and have introduced a few more recommendations, that is issuance of quasi-sovereign bonds to increase dollar inflows into the country and sterilize the outflows. As you all might be knowing, an increase in the US interest rates is actually going to lead to flight of capital outside the country. So we need to counter that as well, because you know that capital inflows and outflows, they lead to macroeconomic instability. So we need to counter that. At the same time, corporate debt, it is also a huge factor, because when the dollar appreciates due to an increase in the interest rates, the foreign denominated corporate debt is going to rise, as well as the government debt. So we need regular monitoring and stress tests to assess whether the foreign currency risk is at a threshold level or is beyond the threshold level. So we need to put an adequate cap on that, so that the financial institutions are not exposed to risk as and when hot money inflows and outflows happen due to spillovers from other advanced economies. So these are the basic macroprudential and monetary policy measures which I have detailed here. Now, moving on, we have certain fiscal recommendations. As you all know, adherence to fiscal deficit target any day anyone might recommend, and that's the case for every government to move forward. At the same time, widening of the tax base. Now, ladies and gentlemen, we had an increase in the US interest rate, and at the same time an increase in the prices of the international basket of crude oil. So what that is going to do is that it is going to increase the fiscal deficit. So we cannot cut back on expenditure, because public expenditure is the need of the hour. So what do we need to do is actually to increase the revenue, and increasing revenue does not mean burdening the salaried class with more taxes. So in consonance with the Laffer's curve, which says that less taxes and a wider tax base leads to higher tax collections. So that is what we have recommended. And then, of course, foreign direct investment, hard capital flows are the need of the hour any day as compared to foreign portfolio investment. So to attract that, we need better measures like ease of doing business, faster project approvals, etc. Now, greater capital expenditure, which is required, in fact, more as you might be observing in the subsequent editions of the union budget, the non-plan expenditure and the plan expenditure, there is a gradual rebalancing, and we are having more capital expenditure to actually spur the economy. And the import duty, which is currently there, that we expect it to remain intact in order to preserve the sanctity of the CAD, which might go up because of the huge fuel prices. Now, at the same time, fiscal prudence should be adhered to, that is a complete switch over to Aadhaar-based direct benefit transfers, which is actually going to ensure the subsidies which are meant for the poor actually reach them. Now, basically, I would now begin with an assessment of the Indian economy. As set out by the Honorable Urjit Patel Committee in its recommendations, inflation was to follow a glide path, and it was to remain within a corridor of 4 plus minus 2%. So at the current levels, it is at around 5.18%. Industrial sector, as you all might know, as per the latest data, the index of industrial production has in fact contracted by 1.5%, and this is basically due to lack of new credit due to existing NPAs, as well as weak external demand, because metal prices have come down, steel prices have come down, so that has contributed a lot. So this is actually a corroboration of what I spoke. The World Bank has in fact predicted in its World Global Economic Monitor that industrial production is actually sluggish. It has flattened and it is also contracting, as you can see from the graph. Now, liquidity conditions, tight liquidity conditions, of course, prevail due to high government cash balances and as well as low credit offtake. So, we had to kind of strike a balance between actually tightening the monetary policy in view of expected inflation due to increase in the fuel prices, as well as to counter low liquidity levels. So, we kind of struck a balance. Now, coming on to agriculture, the high, as you all know, high agricultural input prices have actually not passed on the benefits of higher MSP. So that remains a concern. And moving ahead, given the scenario we have, increase in the fuel prices as well as the depreciation in rupees is actually going to increase the agricultural input prices. So that is going to put a huge strain. Now, my Deputy Governor for Monetary Policy will take over.
Good afternoon to one and all. Now it comes to the foreign institutional investment part. So because we have been provided with a situation in which the Federal Reserve have increased the rates, and hence it will be the propensity of investors to move forward to the United States and invest there, because they will be going to get more returns on their investments in US. So definitely the capital is going to flow from India to US, and so there will be a flight of capital from the Indian market, and we'll have to contain that as well while we look at the current account. Then moving on to the public finance, especially the oil import, given that the oil prices would increase to $70 a barrel, which is right now close to $36 or 35 a barrel. There is it's completely doubling immediately and abruptly. So given that our import bill, 80% of the oil that India needs is being imported, and hence this will be the train that we suppose it will be followed in March, and also this is going to continue. This is going to cost really very much to our import bill. And then coming to the current account deficit, because a major portion of our expenditure on imports is in oil, and because oil prices are to be doubled because of some developments which are not in our control in the Middle East. So this is how it's going to cost our current account, and we will be facing a deficit in the time to come, and this is also going to continue in the coming fiscal, that's 16-17. And then here's the fiscal deficit. All the red spots, they show the actual fiscal deficit, and the blue ones the target. And we see that in 2011 and 12 it was there is a difference between the target and the actual fiscal deficit, because at the time the oil prices was not as low as it is now, and only because after 2013 onwards the oil prices, they have plummeted. Now we were seeing that there is a decrease in the difference in the gap between the target and the actual what has been achieved. So this definitely will follow, because even the government is on a path of fiscal consolidation, and we'll hope for the best. Now I will hand over the mic to my fellow Deputy Governor to continue.
So now here we see that services sector. The services inflation has been high for a long time, and it also means contributes to a major chunk of India's export. Also, if there is a outflow of capital from India, there would be a stronger dollar to rupee, which implies greater impetus to the export. Now, this would help in increasing forex reserves in future. Now, we provide here the rationale for policy recommendations. Now, as we see that increasing crude oil prices always exert a huge pressure on our inflation, as India imports more than 80% of its crude oil needs. Also, the projected path of inflation due to the increase in this oil price from $37, which is hovering around $37 currently, to $70 would push it to 5.89%. This can be gathered from an empirical report from which we gathered that for every 10 barrel rise in the price of crude oil, there is a more than 0.2% rise in the CPI. Now, we also need a higher industrial credit on account of low industrial investment and growth. Why? Because India is a developing country, and if its industry do not get enough credit for its own, then there would be no push for growth of industries and other sectors also, because most of them are interlinked. Sorry. Now, Reasons for the unchanged rates: deficit liquidity conditions are prevalent currently, and if there is also means more outflow of capital from the country, there'll be more tightening of the liquidity conditions. Also, the investment cycle needs to be corrected, and countering a marginal increase in inflation due to the oil prices is also a target. Now, balance is to be maintained between this critical juncture between the inflation rise and the more liquidity conditions which would be facing. And this can be made in the future by observing the global and national economic developments. Policy rationale for to neutralize the flight of foreign capital. Now we have to stop the flight of foreign capital, because if there is less liquidity in the market, then there would be a lot of problem. Now, strong macroeconomic fundamentals are required in order to stop the stop the flight of foreign capital. Also, this implies higher GDP growth, for which there is a need of structural reforms. Now, currently we have a stronger current account position and a lower inflation, but due to the given scenarios, it won't be possible anymore. Now we have to maintain a sufficient forex reserves to sell dollar bonds in order to offset the crisis that can be caused due to the outflow of foreign capital. So stronger FDI, we can see from here, that implies a stronger balance of payments. Now forward guidance would be provided by our governor.
Now, to sum up at the end, ladies and gentlemen, as you all know, the RBI sets short-term policy rates, but long-term because the consumers as well as the industry, they take investment decisions as well as the decisions to buy the consumer durables based on long-term rates, and long-term rates are actually a time average of future expected short-term rates. So forward guidance is highly necessary to set out a predictable economic path for the economy. So at this juncture, the single point agenda, as was pointed out by the Urjit Patel committee, and as the present set of policymakers in RBI, which we also follow that, and that is inflation targeting. Now going forward, as has been aptly highlighted in preceding policy reports, is that the pay commission as well as the OROP recommendations, they are actually expected to exert upward pressures on inflation, given the fact that we already have high oil prices at $70 per barrel. So, and RBI would monitor that. In case inflation increases, like we maintained a status quo on the rates. In case inflation increases beyond the threshold level of 6%, as has been set out, the RBI would not be hesitant to actually follow a tighter monetary policy. Now, that would happen if oil prices come down below $50 a barrel, and to kickstart the investment cycle, policy rates would actually go the reverse. So we would have no hesitation whatsoever to follow an expansionary policy. And coming to the flow of volatile capital inflows, as is the general fallout of spillovers from advanced economies, RBI would take all steps to sterilize capital inflows, be it the market stabilization scheme or be it the schemes which we talked about, that is floating of the quasi-sovereign bonds. So we would not hesitate from taking those steps. And that's all RBI has to offer for today. Thank you so much.
Thank you very much, Governor, and to the monetary policy team. My colleagues and gentlemen from the press would like to ask you some questions. Perhaps I can hand over the mic to Sri Mundra first.
To begin with, thanks. A very nice presentation and a wide range of ideas. I was little intrigued to see a couple of recommendations. One, you had mentioned that you would like the state finance bodies to use, quasi-sovereign bonds in the international market to augment the dollar inflow. And you also recommended that there would be open market operations, dollar, to deal with the forex situation. Now, what exactly in the mind by these measures and state finance companies would you consider from the perspective of the risk management, that they should be encouraged to issue the dollar-denominated bonds?
It's a Could you please repeat the last sentence?
Uh, you know, state finance companies, particularly, you have mentioned that they should issue the quasi-sovereign bond dollar denominated. Now, from the viewpoint of the forex risk and the financial condition, these companies where which they are already, uh, don't you think that there would be associated risk in this recommendation?
So that definitely would be a risk, but given the fact that India needs huge expenditure, we recently had a national infrastructure investment fund which was set up. So what that the sole aim of all that was to gather investment in the infrastructure sector. But given the fact that the scenario we have is a huge flight of foreign capital, we actually thought of leveraging the outflowing foreign capital to meet the infrastructure requirements of the country. Now, my deputy governor, financial services, will actually take it forward.
Sir, means we focused on infrastructure because infrastructure is the backbone of our Indian economy. We have a potential to grow further, but we can't because of the absence of a proper economy. Proper infrastructure. Now, if we leverage that point from it, if we can turn a negative into a positive somewhere else, then that would be a better point. That's why we meant to say that.
I think Mr. Mundra is referring to the fact that you're hoping that growth comes before the liability comes due. And if the liability is so much higher because the currency is depreciated, that's a risk to the financing. But let me now ask Professor Errol de Souza to ask a question.
Let me sort of add on to that question by asking what would be the implication for the exchange rate. I mean, would you like to give up forex reserves? What would you do on the exchange rate front, supposing capital flows turn out to be volatile? And secondly, you made some recommendation about imports for gold, and you said you should increase the duty rates. Would that not lead to evasion, or what would it lead to? I mean, has it really been fruitful for India in the past, in your eyes?
So we actually, answering your second question first, we did not actually recommend an increase in the import duty. We actually recommended the present duty structure to stay, in the sense that gold imports should not increase and actually add on to the fuel burden. So the present import structure should stay, import duty structure. Coming on to your first question, which was that whether we need to intervene in the forex market, right? So the exchange rate channel of monetary policy transmission in India is quite feeble. So if we increase the interest rates or decrease the interest rates, there is a higher impact on the equity channel rather than the exchange rate channel. So we do not need to intervene in the forex market as of now, because as I said, we have sufficient forex reserves, and that is $355 billion of forex reserves, and we actually suggested some measures to augment our forex reserves. As regards to flight of the capital, which would lead to volatility in the rupee, we suggested some measures which can actually lead to leveraging that flight of capital to finance our infrastructure development. So that's it.
I'll add one thing. So, sir, dipping into the forex reserve would be only when there is a sudden and a immense flight. We won't give up our forex reserve just for nothing over a small volatility. In case there is a large scale volatility, now we have to maintain the stability in the market, then only forex reserves can be used to even it out. That's what I'm saying.
Okay. Sajid Chinoy, Chief Economist, JP Morgan.
Thank you very much, Governor. Thank you for a very comprehensive presentation. I think implicit in your policy recommendation not to raise rates was you are concerned about growth. And I think for a central banker, you need to know where is growth compared to potential, because I think what you were hinting at is that you don't expect inflation pressures to rise even further. In India, we are struggling with two things. We're struggling to make sense of our GDP series, and therefore it's hard to tell how much slack there is in the economy, and we don't have any unemployment data to tell us if there's slack in the labor market. So as a central bank, I have a two-part question. As a central banker, what telltale signs in the economy do you look at to understand, is there slack in this economy, and is there slack getting wider, or is the slack gradually closing? That's my first question. The second is, in your last slide, you were very poignant about the fact that your sole objective is inflation targeting. at some point, do you see this tension where if you are focusing on largely on inflation, you will not be able to focus on the exchange rate as well and control that, because there could be this inherent inconsistency between trying to follow an exchange rate policy and trying to keep inflation within your targeted level. So thoughts would be very appreciated.
So your second question first. So you talked about whether we need to actually focus on inflation or exchange rates. So the thing is, the sine qua non of following a proper macroeconomic policy is actually looking at stronger stability rather than stronger growth, because stability in the long run ensures growth. So when you talked of interventions in the higher attention to exchange rate rather than higher attention to inflation, as I just said, exchange rate channel of monetary policy transmission in India is feeble. And so why we talked of targeting inflation is that keeping inflation within a certain limit in the long run is actually going to ensure growth. So we have actually adopted inflation as a nominal anchor. So that is why we thought of actually anchoring our monetary policy to inflation. Your first question was regarding whether we think there is a inflationary gap, right? Yeah. So current statistics, what do they reveal? It's that a lot of inventory has built up, and and in addition to that, there is low capacity utilization. And now, why has that happened? That has happened primarily because of low demand, be it externally or internally. So we believe that we need to have a two-pronged policy. Instead of actually giving an impetus to infrastructure or giving impetus to manufacturing sector without looking at the demand side, so that will lead to problems. So what I feel about your question is that there is a slack in the economy. At the same time, we have to wait for some time for global growth to pick up, for global demand to pick up, so that we have proper demand for Indian goods. At the same time, RBI is quite vigilant. It's quite vigilant to see whether demand has picked up to commensurate levels, and we shall effect appropriate monetary policy transmission interventions in that regard.
Tamal?
Yeah, Governor, thank you. You started saying that we are actually staring at a crisis. And the recurring theme in your policy document, Hello. Yeah, Governor, thank you. You started saying that you are staring at a crisis, and the recurring theme of your policy, you did say, one is this, of course, the oil price hike, and you also explained then how every $10 per barrel hike affects inflation and all. And secondly, you spoke about the flight of capital. And there, traditionally, what I have seen the central bank in the recent past, Dr. Raghuram Rajan's regime, we saw certain other ways of attracting capital, FCNRB. But you even gone beyond that, quasi-sovereign bond you recommended. So it's a very serious situation. But there, instead of rating, wasn't it to stall the flight of capital and also the impending threat on inflation, shouldn't be a right way of hiking the rate? Instead, at the end of the policy stand, you spoke about cutting the rate. You said that we are expecting the oil price to go down to 50 and then we'll cut the rate. So do you see there's a contradiction in this? And another observation I would like to comment on that. Traditionally in media we speak about RBI's autonomy is at threat. But it seems like the finance ministry's autonomy is at threat, because you are recommending a series of fiscal measures what the ministers should do. I mean, did you have a discussion with Mr. Jaitley before that, or is it an infringement into finance ministry's domain? Can you explain that?
Sir, after all, the finance minister is my appointing authority. So I cannot infringe on the finance minister's domain. As per the mandate given to us, we had to suggest a few fiscal measures. So we never think of stepping on the finance minister's toe. He's an angry person, I know. So Sir, actually, you may have missed out that once we kind of highlighted two scenarios. Like if there will be reduction in the dollar per barrel, that is the crude oil rate, then we might be actually pleased to decrease the rates given the current moderate inflation. And if this scenario continues, or if there is an increase in the crude oil prices, then we'll be constrained to increase the rates. So we have kind of highlighted two scenarios. And the first question which you talked, could you please repeat that? I kind of.
No, I said that given the kind of scenario that you projected, you called it a crisis, and you are really scared of flight of capital, you are going to even issue going for quasi sovereign bond and all. So wouldn't have a rate hike? Wouldn't have been wasn't it an appropriate situation? There's a classical monetary theory says that when you are scared of your flow of flight of capital, the way one of the thing is could have been a rate hike, wasn't that?
So a rate hike was the most classical way to go forward. But given the fact that industrial growth is at an all-time low, we do not expect a contraction, and which has actually happened in the last IIP data. So what we tried to strike a balance. So given the deficit liquidity conditions, as well as the impending rise in the crude oil prices that was given to us in the scenario, we actually struck a balance. So in case conditions tighten as and when further, the RBI is aptly vigilant, as I said again and again. In case conditions tighten, then we might look at the conditions and we might increase the exchange rates. Interest rates. So my DG of financial services.
Sir, I have pointed out the fact that there is already a tight liquidity situation in our country. So if there is a flight of capital from the country, it would create a credit crunch of a huge margin. So now if we again raise the rates, then that would create a great problem. There would be no balance. That's the thing.
And so I just want to add one more point. So whatever be the situation given to us, it's given that there is some happening in a different country, but still then in India, what we believe is that we are still one of the most preferred locations for investment for foreign countries. So we do not want to tinker with that. So and we have not increased our rates because we always want that the banks should be free to give the credit to the interested creditors, and also they should be able to seek that credit. So in case we increase a rate right at this juncture, so and given the problem of bad loans, as so everyone will be just demotivated to take loans and start up a business. And we are from Odisha, and when we flew into Mumbai, we saw how investment can really affect an economy and what role has it got to play.
I'll just sum up. We actually showed some FDI data, and we have been reiterating again and again. Hard capital rather than foreign portfolio investment is the need of the hour. So to increase FDI flows into the country, we need to create a conducive atmosphere, and bank credit is one of that. So that is why we did not decrease the rates.
Well, thank you very much, Governor and Deputy Governors, for an excellent presentation and very nice answer.